This lecture covers the income statement. I'm your professor, Dr. Stephen Hager. Just as the balance sheet has its equation, so does the income statement. The income statement equation is revenues minus expenses equals income. The income statement represents the performance of a company over a period of time, usually a quarter or a year. If the company is publicly traded, you'll be able to find a copy of their income statement in their annual report. We can think of the income statement as being a video over a period of time rather than the snapshot that's represented by the balance sheet. Once again, the balance sheet represents the firm's financial status at the end of a period, which is just a single point in time, whereas the income statement records everything that happened over a period of time. We see here a fairly typical income statement. The first line is total operating revenues. This represents the money that the firm has brought in through its operating activities, typically selling goods or providing services. It won't always say total operating revenues on the top line. Sometimes it will say sales or total sales, but you shouldn't be confused. The top line is always all about the money that's being brought in by the firm's operations. The next line says cost of goods sold. This is what we had to pay for the items that we sold. Cost of goods sold will include the cost of items purchased, can also include labor or electricity that is used in the production of a product. In other words, anything that can be traced directly to the production of the product or the acquisition of the product will show up in cost of goods sold. That contrasts with selling, general, and administrative expenses. By definition, these cannot be traced exactly to the production of or acquisition of items for sale. In this account, we will find commissions and salaries for salespeople. We will find the CEO's salary, the front desk receptionist's salary, perhaps travel expenses that are not related to the production process, and other items that cannot be directly attributable to the production or acquisition of a product. Next we see depreciation. Depreciation is a non-cash expense. We'll discuss later what we need to do to make an adjustment for this, but in the calculation of net income, we still need to consider depreciation, especially because depreciation can impact our taxes. Finally, we subtract out the cost of goods sold, selling, general, administrative expenses, which are also called SG&A expenses, and depreciation from total operating revenues to come up with something called operating income. The next line says other income. Now this is income we have received, perhaps a gain on a sale of an asset, perhaps it is interest we have earned on some monies that we have invested that are not part of the operating process. We're going to add those together and come up with earnings before interest and taxes. Now, depending on where you're from, this will be either pronounced EBIT or EBIT. You choose. Next, we will subtract out interest expense. The United States Tax Code allows us to deduct interest before calculating taxes. We will see later when we discuss cash flows that interest expense should be thought of as a financing cash flow, but to the accountant, interest expense is actually an operating cash flow. This is one of the areas where accountants and finance people disagree. After we subtract out interest expense, we wind up with something called pre-tax income. And this is the number that we figure our taxes based on. The next line has taxes of 84. However, note that that is broken down into two different kinds of taxes, current of 71 and deferred of 13. current taxes are ones that we are going to have to pay to a governmental body during this period, or that we did have to pay during this period. However, deferred taxes are taxes that we owe but will not have to pay until some future period. As discussed previously, deferred taxes arise when we report our financial performance to shareholders using straight-line depreciation for our assets, and report our income to the government using accelerated depreciation, or MACRs. The difference shows up here in deferred taxes. Over time, as we get closer to the end of the life of the assets, you'll see that these deferred taxes will go back down. In the meantime, though, deferred taxes don't represent a real cash flow any more than depreciation does. After we've subtracted out taxes, we have net income. And net income always goes to one of two places. It can either go to addition to retained earnings, which we will see becomes part of shareholders' equity, or can be paid out to the shareholders in the form of a dividend. This equation will always hold. Net income equal to addition to retained earnings plus dividends. Note here that addition to retained earnings and dividends are the same number. That is mere coincidence. The firm could have paid out 0 dividends, then it would have had 86 in addition to retained earnings. Or the firm could have chosen to pay out 86 in dividends and had 0 in retained earnings. What we see is that companies can make these choices, and that's called dividend payout policy. Many startup firms do not pay dividends at all. Most dividend-paying firms are older, mature, cash cow type operations. As much as accountants would like to think that the income statement represents cash flows, this is incorrect. First of all, sales might produce accounts receivable instead of cash. This occurs when we sell to our customers on credit instead of receiving cash payment. Similarly, when a supplier sells us goods on credit, instead of paying out cash, we get an accounts payable on our balance sheet. And so instead of consuming cash, like the income statement might infer, we actually have an accounts payable on our balance sheet. Also, depreciation does not consume cash. Depreciation is what we call a non-cash expense. In reality, when you buy a piece of equipment, the entire cash flow for the price of that equipment happens up front, and the depreciation that is booked later on to represent that initial investment does not consume cash at all. And finally, deferred taxes do not consume cash, even though they are subtracted as an expense on the income statement. Eventually we will have to pay these deferred taxes, but not in the current period, not in the period of the income statement. There are at least 3 areas where we see linkages between the income statement and the balance sheet. Here we have an income statement and balance sheet for the same firm. The income statement is for the period of 2010. The balance sheet shows the period end amounts for 2009 and 2010. And so the difference between the balance sheet 2009 and 2010 amounts represent changes that occurred over the year of 2010, the same year represented by the income statement. First of all, let's look at depreciation. Our income statement shows depreciation of 90. Let's look down now at the balance sheet under fixed assets. Look at the account accumulated depreciation. It's immediately below property, plant, and equipment. It rises from 460 to 550 over the period of the year 2010. What's the difference between 550 and 460? It's exactly 90, the same amount that we see for depreciation in the income statement. Also, we can see for deferred taxes, a relationship between the income statement and the balance sheet. The income statement shows deferred taxes of 13. Now take a look under long-term liabilities on the balance sheet. Deferred taxes went from 104 to 117. What's the difference between 117 and 104? It's exactly 13, the amount that we see on the income statement. And finally, notice accumulated retained earnings on the balance sheet. It rises from 347 to 390 over the period of the year 2010. The difference between these two numbers is 43, which is exactly the same number we see under net income for addition to retained earnings. Notice that net income of 86 becomes 43 of addition to retained earnings and 43 in dividends. Therefore, we know that accumulated retained earnings should rise by 43 over the same period, and the balance sheet shows that indeed it does. Corporate taxes in the United States, similar to personal taxes, are progressive in general, meaning that higher levels of pre-tax income are subject to higher tax rates. The taxes are figured one bracket at a time. The pre-tax income climbing into the next bracket does not increase tax rate on pre-tax income that occurred below that bracket. You may often hear people say, I don't want to make any more money this year because it will push me into a higher tax bracket. These people are idiots because the new tax rate only applies to the income earned in that bracket. It doesn't apply to the income earned in the lower brackets. In fact, the first few $1,000s that you make, personal income-wise in the United States, has no tax at all, so the tax rate would be 0% for that money. There are two important tax rates for corporations that we need to consider. The first is the marginal tax rate, and the second is the average tax rate. The marginal tax rate is defined as the tax rate on the very next dollar earned. If you are in a low pre-tax income situation, in a progressive situation, progressive tax regime, that rate will be low. If you have higher pre-tax income, that marginal tax rate will be higher. So the firm's marginal tax rate will increase as the firm's pre-tax income increases. Then we have the average tax rate. This is simply the total taxes of the firm divided by the taxable income. It's much easier to calculate, but it actually is less meaningful in finance. Here's why. When we examine a project to determine whether or not to accept it and to invest in it, the tax rate that we are interested in is the marginal tax rate, because we expect this project to create income on top of the pre-tax income we already have. And so the important tax rate to consider is the marginal tax. What are we going to have to pay on this new income, not the average tax rate? Here we have a set of tax brackets for corporations. Now, keep in mind that tax rates change because they are a result of acts of Congress, and Congress changes hands and things happen there. And so what I would advise you to do if you wanted to find out what the current situation is today, go to the IRS's website and look up corporate income tax rates, and you'll find a similar table that is up to date. But for our purposes, we can use this table to work an example. Let's take a firm with a pre-tax income of $200,000. According to this table, on the first $50,000 of that income, they are going to pay a 15% tax rate. So notice on the first line of the example, we have 50,000 times 0.15, that's the decimal equivalent of 15%. That's equal to $7,500. Now, when we do these examples, you always want to ask yourself, have we covered all of the pre-tax income? In this case, we've only covered the first 50,000, and we are on our way to 200,000, so we must continue. Next, we see that for incomes between $50,000 and $75,000, there's a 25% tax rate. Notice the table says 50,001, so there's a dollar gap in between these two, the first bracket and the second bracket. Do not be fooled. The United States government is not going to allow you to escape paying taxes on that dollar. So instead of subtracting 50,001 from 75,000, we're actually going to subtract 50,000. Then we're going to multiply that by 0.25, which is a decimal equivalent of 25%. That's the tax rate for all income between 50,000 and 75,000. Now, look on down, we have a bracket that goes from 75 to 100,000, and the rate on it is 34%. Have we reached 200,000 yet? No, so we must continue. 100,000 minus 75,000 multiplied by 0.34, that's 34% in decimal form, is $8,500. Have we reached 200,000 yet? No, so we must continue to the next bracket. Now the next bracket goes from 100,000 to 335,000. Our 200,000 falls somewhere in the middle of that bracket. And so now, instead of putting the top of the bracket as our big number to subtract from, we're going to put our pre-tax income of 200,000 in. So 200,000 minus 100,000 multiplied by 0.39, that's the decimal equivalent of 39%, gives us $39,000. Now when we add all these numbers together, 7,500 plus 6,250 plus 8,500 plus 39,000, we arrive at $61,250. This is the total amount of tax that the firm would have to pay. In order to figure our average tax rate, we would simply take that number and divide it by the pre-tax income. That would give us an average tax rate of 30.625%. Is that the same as the marginal tax rate? Absolutely not. Remember that we defined marginal tax rate as the tax rate on the very next dollar earned. Since we left off somewhere in the middle of the 39% tax bracket, we can expect to pay 39% on the very next dollar earned. By definition, that's our marginal tax rate, 39%.